Welcome back to the show. So, we need to talk about the Federal Reserve. They just wrapped up their final meeting of 2025. And let me tell you, the vibes were interesting.
Oh boy, I saw the headlines. They cut rates again, right?
They did, third time in a row. They shaved off another 25 basis points. But the big story isn't the cut itself, it's the warning that came with it.
Okay, so we got the cut. Where does that put us?
Short-term rates are now sitting in that 3.5 to 3.75% range, but the Fed is signaling that we've hit neutral territory.
Neutral? So they're basically saying we're done helping for a minute?
Exactly. They are ready to hit the pause button and just watch what happens next.
Was everyone on board with this? Usually they present a united front.
Not this time, that's the drama. The vote was 9-3. We haven't seen three officials dissent in 6 years.
Wow, a split house. That really shows how uncertain things are getting regarding where the economy is actually heading.
And for everyone listening, hoping this rate cut means cheap mortgages tomorrow, don't hold your breath.
I knew you were going to say that, because the market already expected the cut, right?
Bingo. The 30-year fixed rate is hovering around 6.19%. It's the lowest of 2025, sure, but we aren't seeing a free fall. It's pretty sticky right there.
So what was this warning from Fed Chair Powell you mentioned earlier?
It was blunt. He literally said, housing is going to be a problem.
Yikes, that's not exactly comforting coming from the guy in charge of the money supply.
Right? He basically admitted that a tiny rate cut doesn't fix the fact that we just don't have enough homes.
It's that lock-in effect we always talk about. People grabbed those ultra-low rates during the pandemic, and now they refuse to move because rates are 6%.
And Powell said the Fed doesn't have the tools to fix a structural housing shortage. They can tweak rates, but they can't build houses.
Exactly. So inventory stays low and prices stay high.
What about the rest of the economy? Is inflation still the big bad wolf?
It's still there, about 3%, which is above their target. There was a temporary bump from those tariffs the Trump administration put in earlier this year.
But it sounds like they're shifting their worry toward the job market now.
Spot on. The labor market is softening, and that's actually their bigger concern moving into 2026.
So, what happens next? Experts are kind of divided. Some think rates might actually creep up while the Fed plays the waiting game.
But wait, didn't I read about missing data?
Yes, because of the government shutdown, there's a backlog of labor and inflation data coming out before the January meeting. That could totally change the game.
Is there any good news here? I feel like we need a silver lining.
There is. Daniel Hale from Realtor.com pointed out that affordability is actually improving.
How so?
Well, as incomes rise, the chunk of your paycheck going to housing is dropping. It's expected to dip below 30% for the first time since 2022.
Okay, I'll take that win. So 2026 is looking like, what, a comeback year?
Economists are calling it a transitionary year. We might finally see home sales tick up from these 30-year lows.
Fingers crossed. We'll keep watching the rates so you don't have to. Thanks for listening, everyone.